Your portfolio looks fine right now. The market's still near record highs. Your news feed tells you everything is under control. But while you're watching those green candles, something is happening behind the scenes that most investors will miss until it's far too late. The panic phase has already begun, and the truly terrifying part? It's not showing up on the headlines yet. Let me ask you something. Why would major institutional investors suddenly start buying physical gold and silver at the fastest pace in years? Why would central banks around the world start dumping dollars and moving into hard assets? Why would the smartest money in the world be positioning for something that the mainstream media keeps telling you isn't a problem? This is the confusion most retail investors face right now. On one hand, you've got CNBC saying the economy is resilient. You've got Fed officials claiming inflation is under control. You've got earnings reports showing corporate profits holding up. So you sit there, caught between two realities. The official story says stay calm. Your gut says something is very wrong. And here's the thing that keeps you up at night. You're not wrong. But that's only the surface explanation. Because the real question isn't whether something bad is coming. The real question is understanding the mechanism of how panic unfolds in a system like ours. And once you see that mechanism, you'll understand why certain investors are moving right now and why the average person is still asleep. Here's what most people miss. Panic doesn't happen all at once. It happens in phases. There's a trigger phase, there's a contagion phase, and there's an acceleration phase. We're in the trigger phase right now, and the signals are already flashing red. Let me walk you through exactly how this works. Step 1. The system we live in is built on confidence. Not on gold, not on hard assets, not on physical reality, on confidence. The entire global financial architecture, your currency, your bonds, your savings account, all of it, is built on the collective belief that these things will be worth something tomorrow, that the person on the other side of the transaction won't default, that governments will meet their obligations, that central banks can manage the system responsibly. Now, what happens when that confidence starts to crack? Step 2. It cracks at the margins first. A bank fails, some geopolitical tension rises, a supply chain problem emerges, an inflation number comes in hotter than expected. Most people shrug it off. One problem doesn't break the system. We've weathered storms before. But here's where it gets dangerous. While retail investors are shrugging, institutional players are watching something else. They're watching the cracks spread. They're seeing debt levels that are mathematically unsustainable. They're watching central banks create inflation with one hand while claiming they'll control it with the other. They're watching a political system that's increasingly fractured and unpredictable. They're watching supply chains that have never recovered from the pandemic shock. They're watching geopolitical risks multiply. And most importantly, they're watching other institutional players start to move. Step 3. Once smart money starts moving, it creates a feedback loop. Central banks notice the buying pressure in gold and commodities. They wonder why. Pension funds notice the allocation shifts. They start asking their advisors what they're missing. Hedge funds see the signal. Corporate treasuries see it. And then, this is critical, ordinary people start to notice something is off. Suddenly, the boomer who keeps talking about gold doesn't seem crazy anymore. Suddenly, the person who's been stacking silver starts to look prescient. And this is where everything changes. The panic phase doesn't start with a crash. It starts with a shift in positioning. It starts with a change in what the smart money is doing. By the time the average person realizes what's happening, the early phases have already played out. The people who moved early already have their positions. The window of opportunity begins to close. The real mechanism is this. We're in a system with too much debt. Governments owe more than they can realistically repay without devaluing their currency. Corporations have borrowed to buy back their own stock. Households are extended. The Federal Reserve created trillions of dollars out of thin air and then acted shocked when inflation appeared. Interest rates went from 0 to 5% in the fastest pace since the 1980s. And now there's a structural problem. Nobody can afford these rates. Banks are starting to look fragile. Commercial real estate is collapsing. Student loan payments just restarted. Credit card debt is at all-time highs. But that's not even the main problem. The main problem is that the system can't solve this with rate hikes anymore. If the Fed hikes rates further, it collapses the banking system and real estate market. If the Fed cuts rates or prints more money to fix this, It restarts inflation and destroys the dollar. This is a classic policy trap, and trap systems are the ones that generate panics. Meanwhile, the geopolitical backdrop is shifting in ways most investors haven't fully grasped. The dollar's dominance is eroding. More and more countries are settling trade in their own currencies or in gold. The BRICS nations are building parallel financial systems. China is aggressively acquiring resources. Russia is tightening its currency to gold. These aren't random moves. These are strategic positioning for a post-dollar world. And while this macro backdrop is shifting, the Fed is pretending everything is fine. The government is running deficits that would make any responsible economist weep. And most retail investors are sitting in cash earning 4% or in stocks at historically expensive valuations, completely unaware that the institutional players have already started to move toward hard assets. History shows this pattern again and again. Look at the 1970s. For years, people kept hearing that inflation was transitory. Central banks insisted they had it under control. Then gradually, in the early 70s, smart money started moving into commodities and precious metals. By the time the average person realized what was happening, gold had already appreciated significantly. Those who positioned early saw their assets double, triple, quadruple. Those who waited until the panic was obvious paid much higher prices. Or look at 2007 and 2008. The real positioning started in 2006 and early 2007. If you look at what institutions were doing, not what they were saying, but what they were actually doing, they were already moving out of mortgage-backed securities and into credit protection. The hedge funds that made billions saw it early. By the time Lehman Brothers failed and the panic became visible to everyone, it was almost too late. Or look at the 1980s. When Volcker raised rates to kill inflation, gold prices had already started rising before the real shock. In fact, gold had started moving up in the mid-70s, years before the actual crisis moment. The people who owned gold through that period watched their purchasing power held. Everyone else watched their savings eroded by inflation. Even more recently, look at 2022. Before the banking crisis headlines, the smart money was already rotating. Before SVB collapsed, there were whispers about interest rate risk in the banking system. Before the headlines, the positioning was already changing. Every major financial shift follows this pattern. The institutional players move first, then the early retail investors move, then the crowd panics, and by then, the best opportunities and the best protection are already priced in. The question isn't whether this historical pattern will repeat. The question is whether you'll see the signals this time. But here's why this moment is different. It's not just one problem. It's a convergence of problems, all at the same time. We've never had this level of government debt combined with this level of central bank balance sheet expansion, combined with this level of geopolitical fragmentation, all happening simultaneously. In the 70s, there were inflation problems, but there wasn't a currency war. In 2008, there was a financial crisis, but government debt levels were manageable. In 2022, there was a banking panic, but geopolitical risk was lower. Right now, all three variables are critical. The debt situation is almost incomprehensible. The US government is spending more money than it takes in, year after year. The total national debt is over $33 trillion. The annual deficit is running at over $1.5 trillion. Even if you believe that the economy is growing strongly, you can do basic math here. You cannot sustainably run deficits of that magnitude without eventually devaluing your currency. But that's only the surface explanation. The deeper problem is structural. For decades, the dollar's reserve currency status meant that the US could print money with fewer consequences than other countries. If you needed dollars, you had to buy treasury bonds. This created demand for dollars and debt, which allowed America to run larger deficits. But that system is breaking down. More and more trade is happening outside the dollar. More and more central banks are reducing their dollar reserves. More and more countries are asking themselves why they should hold dollars if those dollars are being systematically devalued. And while this is happening, the Fed is caught. If it tightens rates to protect the dollar and fight inflation, it breaks the financial system. If it loosens policy to save the financial system, it kills the dollar. This is not a problem that monetary policy can solve. This is a structural problem. Meanwhile, the geopolitical backdrop creates uncertainty that compounds everything. the war in Ukraine, tensions with China over Taiwan, energy security concerns, supply chain fragmentation, trade wars. These aren't background noise. These are the kind of catalysts that can destabilize markets that are already fragile. And here's what separates this from previous cycles. The central banks know all of this. They're not fooling themselves. This is why you've seen a historic rush by central banks to acquire gold. In the last few years, central banks have been buying gold at the fastest pace since records began. Why would they do that if they believed their own currencies were stable? The answer is, they don't. They're positioning for what comes next. They're hedging. They're protecting. And if the central banks are moving, you need to ask yourself why you're not. So here's what we're likely to see unfold. Phase 1 is the current phase. Institutional positioning. Smart money moving into hard assets. Quiet rotation. No panic, just positioning. This is where we are right now. Phase 2 is the contagion phase. The positioning becomes visible. More institutions follow. The rotation accelerates. You start to see it in the data. Gold prices move higher. Silver demand rises. The dollar starts to weaken more noticeably. Credit spreads widen. This is when your average financial advisor starts to say things like, maybe you should consider some precious metals exposure. Phase 3 is the acceleration phase. The moves become severe and rapid. Assets that were supposedly safe suddenly aren't. The crowd realizes what's happening. Everyone tries to move at once. This is when you get the kind of volatility that shocks people. This is when buying power becomes limited. This is when prices move fastest. The timeline on this is unknowable. It could be months, it could be a couple of years, but the trigger could be something specific. A banking crisis that actually spreads instead of being contained. A geopolitical event that disrupts trade or energy markets. A debt ceiling crisis that forces the government to actually confront the math. A recession that makes people doubt the Fed's ability to manage. Or something we're not even thinking about yet. Here's what smart money is likely watching. They're watching credit markets. When credit markets start to seize up, that's a warning sign. They're watching the dollar. When the dollar breaks below key levels, that signals a shift. They're watching oil. When oil spikes, that's an inflationary signal. They're watching geopolitical events. When tensions spike, that increases systemic risk. They're watching central bank actions. When central banks stop pretending and start defending their currencies with rate hikes, that's a capitulation signal. And most of all, they're watching the Fed. Because the Fed is at the center of all of this. Every panic, every crisis, eventually comes back to the question, will the Fed bail out the system, or will it let it fail? Right now, the Fed is saying it won't bail out. It's saying interest rates will stay higher for longer. It's saying it won't print. And everyone's watching to see if the Fed will stick to that, or if it will fold under pressure when the pressure gets real. Here are the specific signals you should be watching. First, credit spreads. When the spreads between safe bonds and risky bonds start to widen dramatically, that tells you the system is getting stressed. Watch the difference between investment grade and high-yield corporate bonds. When that gap widens significantly, it's a warning signal. Second, the yield curve. When short-term rates are higher than long-term rates, which is abnormal, it signals that something is wrong. When that inverts and then normalizes again, that's often followed by economic weakness and financial stress. Watch whether the curve normalizes and when. Third, institutional gold and silver buying. This is the signal that smart money is moving. You can track central bank purchases, ETF flows, and large institutional positions. When buying accelerates, it's a signal that people who manage trillions of dollars are positioning for something. Fourth, energy prices. Oil and natural gas are leading indicators of inflation and systemic stress. When energy spikes, inflation usually follows. When energy crashes, it usually signals demand destruction and recession risk. Watch for sharp moves in either direction. And fifth, the dollar index. When the dollar starts to weaken materially, it signals that confidence in the currency is eroding. This is perhaps the most important signal of all, because everything flows from the dollar's status. Here's what you need to understand right now. We are not in normal times. We're in a moment of structural instability masked by surface-level stability. The real economy is fragile. The financial system is leveraged to the breaking point. The geopolitical backdrop is increasingly chaotic, and the policy tools that have worked in the past are no longer available because they would create worse problems than they solve. This is the environment in which panics develop. The panic phase has already begun, not because there's been a crash, but because smart money has already started to move. The institutional players who manage trillions of dollars have already started to position for a world that looks different from the one we're in right now. They're already moving into gold, silver, and hard assets. They're already reducing exposure to currencies and bonds. They're already positioning for volatility. The question for you is simple. Will you follow them early? Or will you wait until everyone else realizes what's happening and the panic becomes obvious? History shows us that the window for early positioning doesn't stay open for long. Once the crowd starts to move, prices move fast. Once panic starts to spread, opportunities get limited. The people who position early, before the panic is obvious, are the ones who come out ahead. The people who wait are the ones who overpay or get left behind. The structural problems that will drive this shift are not going away. The debt is not going to disappear. The geopolitical risks are not going to resolve. The institutional fractioning is not going to reverse on its own. At some point, the market will price in what the smart money already knows, and when it does, things will move quickly. This moment, right now, is your window to position. Not after the panic is obvious, not after the headlines have changed, not after everyone else has moved. Right now. The smartest investors understand that you don't invest after you see the problem clearly. You invest when you see the problem forming, when most people still think everything is fine. That's when you have time. That's when prices haven't moved yet. That's when you can actually position meaningfully. We're in that window right now. If you want more deep market analysis like this, if you want to understand the signals before the crowd does, subscribe to this channel and stay close. Because what happens next is going to reshape how people think about money, about assets, and about wealth protection. And you're going to want to see it unfold in real time. Thank you for watching. I'll see you in the next video.